like an income statement kind of format. Had revenue, we had our operating expenses, we took out our depreciation, had EBIT, we took out our taxes. Real quick little caveat or note. When we did this, let's say that we had, as an example, $1 million here, and our tax rate is 40%. You would owe $400,000 in taxes, right? Well, let's do something different. Let's say that you have an actual operating loss of minus $2 million. What's going to happen there? You're still going to multiply it by your tax rate, so $800,000. But you're not going to owe that. It's going to be positive. It's going to be a tax credit, right? When you have a loss, you get a tax credit that can then be applied to other gains or taxes elsewhere. So, and not just in the project, you may say, well, what if this is all 0 other years? I can't apply this credit to anything else. You can apply it elsewhere inside the firm. So when you have a profit, you end up with a tax, with your basic tax, right, your liability. When you have a loss, you end up with a tax credit that can be applied anywhere in the firm. It doesn't matter where. You simply have to recognize that you've got that credit. Okay, so that's one little thing in mind. That gives us our notepad, right, which is our notepad right there. And then I did this. So I'm gonna leave a little space here to show you what I did, and then we'll see what I did wrong. And then we took out CapEx, and we took out the change in working capital. And we said, that's free cash flow. You see what I did wrong? I forgot to put depreciation back in there. That's why the numbers we got on the problem Thursday were so negative, and yet in the spreadsheet it was a positive NPV. Because I didn't add my depreciation back in. What you take out in depreciation, you add it back in. Now real quick, if I take out $1 million in depreciation and add $1 million back in, why do I bother?
It's not an actual cash outflow.
Well, we add it back in because there's never a cash flow. But why did I bother with it in the first place then? If depreciation isn't a cash flow, why did I even take it out and then add it back in? What does it do? It creates a cash flow. What is it? Or it affects a cash flow. If I have depreciation here, it lowers my EBIT, and that means it lowers my taxes. Taxes will be a cash flow, right? So I have to have it here so I can get an accurate assessment of my tax bill. But because the depreciation never left my firm, it's a non-cash expense, we add it back in. That was my mistake, is I forgot to do this, and that's why we got a negative, because that's a big positive number, right? I left a lot of value kind of off the table because I forgot to add depreciation back in. Okay? So there's that. So there's two things. So one, about tax. So if you get a loss, you're going to have a tax credit, just like if you have a profit, you have a tax liability. Add depreciation back. And then the other thing, and this is more for you guys when you're doing this homework 6, where you're going to put all the cash flows together. If you go, let's say that I've got the following in Excel: columns A and B, and then I've got my rows 1, 2, 3, 4. So here's my spreadsheet. Okay. Let's say year, and then cash flow. Okay. It's going to look like that. So this is going to be year 0, 1, and 2. I've got a 2-year project. And here are my cash flows. It's going to be minus 100, it's going to be 50, and 75. And let's just say down here, I'm going to say, here's my WACC, 10%. Right, so my initial outflow is cell B2. Right, this is my small little version of my spreadsheet. So you've got an NPV formula in Excel, and it's NPV rate, cash flows, and that's it. Now what most people do, what do you think most people do? That's your rate, obvious, right? So you reference your WACC. So That would be cell B5. But here's what most people do, and this is going to be, I'll go ahead and say it's going to be wrong, but here's what most people did the first time they use this. Everybody does it. They go and they say, okay, B2 to B4 are my cash flows, right? Year 0 to year 2. Those are my cash flows. That's wrong. Here's correct way. That was space. When you see what I'm going to do, you're going to like, what the heck? Why is it this way? Don't ask me. Go write Bill Gates, right? So you put your rate in here, okay? And instead of taking year 0 all the way to the last year of the project, you start at year 1, right here. So it's going to be B3 to B4. In other words, your year 1 to your year 2. Your cash flows excluding the upfront investment, right? If it's a 25-year project, it's going to be your first year to your 25th year. Select all that. And then you're going to add in B2 outside of it. I don't know why they did that. They did that, right? It's how Microsoft decided to do the NPV formula. It catches a lot of students out because naturally you're going to say, let's just grab all the cash flows, plug them in there. And why would you think that you should grab them all? Because if you do the IRR formula, it's simply going to say, what are your cash flows? And interestingly, for the IRR formula, you would say they're going to be B2, the initial outflow, all the way to B4, the last inflow. You grab every cash flow for the IRR, but only year 1 to year N for the NPV formula, and the initial outflow is outside of that. It's bizarre. That's how they did it at Microsoft. So that's how you guys have to do it if you use their formulas in Excel. Just be aware of that. Otherwise, if you do it by hand on a calculator, you'll get a different value than you would in Excel. And you'll be off by 1 period's worth of interest, is what would happen every time. Okay, so that takes care of the little technical issues, if you will. All right, now let's get into the topic for today and next Tuesday. So we are on the topic of real options now. So we're going to say chapter 13 and 14. Real options. In fact, what I did here, I wanted to make certain that I found the page in the book. And so in chapter 13, you see 1310, phase decisions and decision trees. So 1310 to end of chapter, I just say EOC. That talks about real options. And then they keep talking about real options in chapter 14. So they they carved part of it out in chapter 13, and then they kept on with the topic in the brand new chapter. A little bit of an odd approach. So let's kind of get an overview of what we're doing here. Then we'll jump really quick into chapter 14 and just kind of do an overview of that, like what are the different approaches we could use. Then we'll jump back into chapter 13 and apply it towards one of the problems at the end of the chapter. Okay, so we're going to kind of bounce around a bit between these chapters. So an overview of this stuff. So what's a real option? Well, the name tells us a lot. An option means you have a choice in the project. And you can say, well, yeah, we have a choice in every project. We have the choice of accept or reject. True enough, but we've got something different going on here. Here, we've got a choice. Once we start a project, maybe we can change directions, right? Maybe we can stop the project before it is scheduled to terminate. Maybe our choice is that we can lock a project in, but not actually, we can lock in the rights to a project today, but not have to do it. We can have some time to make our decision to see how things unfold, right? There's a number of kinds of options, but basically it's a choice you can make. It's a choice other than the invest, not invest decision. That's what an option is. So just like it says, you've got a choice in front of you. To kind of give you a little bit more meaning to this, primary types. Let me do this real quick before I go down that road. Most of you have had, probably every one of you have had the Finance 3357, the investments course, right? And so you've probably had like call options and put options on stock. Let's think about a call option. So a stock call option. And it gives us a little bit of an idea for a real option. Let's say the stock price is 120 a share. Now let's make it 100. The stock is trading at $100 a share, and it has an exercise price, or if you like, what's sometimes referred to as a strike price. Let's say that that's 120, and let's say duration or how long it's going to last. Let's say you've got 2 months. So how would this thing work? It means I could buy this. Let's say that the cost of the option. So the option cost, let's make it $2. I know options are typically on 100 shares of stock. Let's just think about it for a single share, right? Just a single share. So let's see what's going on here. I could buy the stock for $100 a share. I could get a share for 100, right? So I can pay $100. That's it. That's today. I could do that. I could buy the option on the stock, and what's going to happen? I'm going to have an outflow today of $2. That's what's going to cost me to buy the option. What am I doing if I buy the stock? I'm hoping it goes up in value, so I have a profit. Let's say that in 2 months' time, so we'll call it S1. Let's say the price has gone to 150 a share. So I paid 100. I get 150 back. I've made a 50% return. That's pretty good, right, on that investment. But if I bought the option, what's going on here? The option gives me the choice, the right to buy the stock, not at 150 and not at 100, but at 120 a share, right? So I don't want to do it when the stock's trading at 100, but what if it went up to 150? I'm only paying $2 to get that right. So I paid $2, and what I'm going to do is this. I'm going to get stock that is worth I'm going to get stock worth 150. I'll have to pay the exercise price to get that. So I have to pay the exercise price and the option price. So I've made $30. You say, well, you made only 30. You made 150 here, or if you like, a $50 profit over here. That doesn't sound as good, but I didn't pay $100. Right? I ultimately paid $2 here to make this net $30 gain. So I end up with a $30 gain after paying $2. That is, that's a 1,400% gain that I've made on this investment. That'd actually be something like that. That's what it would look like. So I've made a pretty substantial gain. Did I have to? What if the stock, instead of going to 150, what if it had gone to $90 a share? Then over here, at 90, I would have had a 10% loss, right? It's 10% lower than where I started. What about over here? Well, this gives me the right to buy the stock at 120. I'm not going to buy it at 120 if it's trading at 90. That's silly. So I'll just let the option expire and simply not take advantage of it, because it allows me to buy something at a price which is substantially higher than what it's worth. So I can walk away. I can walk away from it, and I'm out $2, and that's it. I've lost my entire $2. I don't have anything else, but that's a lot better than losing $10 over here, right? So that's what the call option does. It allows me a choice to buy the stock or not buy the stock. It's an underlying financial asset. That the rates of return can be better on the option isn't really material for us in here. It allowed me the option, the choice to buy or not buy the stock at this underlying exercise or strike price within a specified period of time, right? Those were some of the parameters of this call option. So why did I bring that up? That's a financial option on a share of stock. We're going to talk about real options, which are, again, choices. You can acquire this thing, like our share of stock, or choose not to acquire it, let the option expire worthless. So those might be our choices. But instead of buying a share of stock, it's going to be to buy an investment, a capital budgeting investment instead. So here, we might have, for example, an option that allows us to invest in this project or to walk away from it, right? So that's where we could have a real option. Let's now think about the types of real options that we get, where we have various choices. So these are some of the things we're going to see today and on Tuesday. One's going to be a timing option. In fact, this will be one of the first ones that we do, or one of the early ones. For example, what if I said invest now and the NPV is $10 million? Well, that looks good, right? That's our rule. It's positive NPV. We should invest. But what if I have the option to wait a year before I make my investment decision? I've got exclusive rights to whatever this investment is. It can't be taken away from me, but I can choose to wait a year before I make the investment. Maybe it's setting up some oil wells somewhere in Texas. I want to see what happens to oil prices over the next year before I pull the trigger on this. Wait 1 year. Maybe my expected NPV is 12 million if I wait a year. So what should I do? I should wait a year because the expected NPV is higher. Does it mean I'm going to invest in the project? No, it means I'm going to wait a year and see what happens. That's a timing option. What about another option? Let's see, what if I invest today? I don't have a timing option. I invest today because it's got a positive NPV. But once I invest, it isn't just like a 4-year project that has an NPV of $10 million. Once I invest, I have the possibility, I know any number of things can happen, right? We did scenario analysis, but I know different things could happen in the future, so I've got uncertainty. Maybe if things go really well, like above expectations, like the best scenario possible, what if it's like a poker game, I could double down and increase my bet? Maybe I could expand the project beyond what I originally thought because I'm on the best scenario possible. That's a growth option. In other words, if we do the project, but it's got multiple possible scenarios, and the best scenario unfolds, it might be worth expanding the project out, to grow it beyond what we originally thought. That might add more value to the project and increase the initial NPV. What if we're on the worst possible scenario out of a bunch of scenarios? It might have a negative NPV for that individual scenario. Remember we did that on Tuesday? We had a 3-scenario project. Oh, it was the mini case, right? We had a positive in one case, and we had 1 or 2 negatives. We had at least 1 negative, right? So was it 1 or 2? It was just 1. So maybe in that bottom case, that mini case, the presumption is if we invest today, we don't know which of those 3 scenarios will unfold, right? The high demand, the average, or the low demand, we call it acceptance. If we're on the poor demand, we just have to suck it up. We're kind of stuck with it, right? But maybe we could walk away. Maybe we could sell off the project to another firm or something. We might not get as much as we originally paid, but we might get something out of it, and it might be better than staying with the project to completion. I certainly wouldn't want to do that if we're on high demand, but maybe on low demand, we might be able to walk away. So an abandonment option. We're going to work problems that have each of these options in it. We're going to work a couple of problems that have multiple options in it. I want to say it's one of the 2 Carolinas, either North or South Carolina. BMW has an assembly plant. Right, they've got a bunch of them in the U.S. You think, oh, they make their cars in Germany. They make a lot in the U.S. because do your production closer to where your end consumer is, it reduces your cost, right? So they have a plant over in one of the 2 Carolinas. I want to say initially it was set up to produce, I could be wrong on this, to produce their convertible, right? Their little 2-seat convertible sports car. But they set it up to where it was more, they had 2 choices at BMW. They could have set up the plant to make just that car and nothing else. But if they ever had to change to SUVs, because SUVs really became hot after they built that plant, they'd have to spend a lot of money to retool the plant to make SUVs, because they're different than a 2-seat sport car. What BMW did was kind of interesting. They spent a lot more money up front so that if they did go change production over from 2-seat sports cars to SUVs, they wouldn't have to retool anything. They'd already be set up to make the switch. They might have a few costs with making the switch, but the machinery and equipment would be the same. It was already there. So they paid the extra cost up front to build in project flexibility in case demand changed. So you think about that. When BMW's capital budgeting team was thinking about the North or South Carolina plant, they had 2 ways they were looking at it. Let's look at they're going to build the sports car. Let's do the cash flows and everything there and scenarios for that and get an expected NPV. But then they said, you know what? We think the market's going to change and it's going to be SUVs. But right now we're going to build a sports car over there. Let's go see, like, how much would it cost us to retool the plant for sports cars? Let's get a cost for that. Now let's go and see how much it would cost us up front to make a plant that could do either, and let's see what would happen then to our cash flows and our costs and our NPV. And it turns out the expected NPV was better, even though the costs were higher, because it would cost them less to switch over in the event they had the demand scenario that says produce SUVs. They're the preferred customer product. All right, so that's kind of in a nutshell or broadly kind of what we're looking at. We're looking at options inside of real capital budgeting projects.
This flexibility option, is it usually an upfront, like?
Mm-hmm. Yeah, so timing is one, wait and see.
Yeah.
Growth, abandonment, and flexibility are all, we're still going to make the decision now, invest or don't, but the expected NPV of that project, the upfront, like do we make the decision or not, is going to be affected either up or down because of these options being included. They can change the value of the project. In some cases, you think, it would raise it, it would make the project more valuable. In other cases, it might lower the project value because the cost of adding flexibility might be higher than the benefits gained. And so having that flexibility option might actually lower the expected NPV. On the other hand, the cost of of adding that flexibility into the plant might be lower than the benefits derived from having it, so the expected NPV of the project increases with that option in it. So this one is a wait and see. These are typically the old invest or don't, but the value of the NPV can change because of the options that are embedded in it. And we need to see how to evaluate those. Now, this is where I'm going to go over for about 5 minutes or so into chapter 14. Just real quick. We'll like in and out fast on it. So our methods. Chapter 14 is 5 approaches to deal with real options. Okay? Well, they list 5 approaches. So this is in chapter 14. You can ignore the real option. Interestingly enough, it's not as silly as it sounds, because to see if the option has any added value, we need to see what the value of the project is without the option and what it is with. Then we can see, did the project gain or lose value with the option, right? So we are going to actually do, number 1, we're going to ignore it. It's going to kind of give us our baseline. In other words, NPV without the option. We want to know what the project's worth without any of this flexibility or these timing options or anything like that. Then, the other 4 methods, they give us 5 methods. The other 4 do include the options, ways to assess the option's value, but they range from fairly unsophisticated to sophisticated. So the first one is qualitative. What's qualitative? It's kind of like, it's a purely judgment thing. It's like, or feelings. It's like, well, we've got this growth option. Certainly it must be valuable. Let's bump up the project value some. How much? I don't know. Let's bump it up 20%. You see what I'm getting at? That's a qualitative assessment. How would you know 20%? I've been doing this for the past 30 years, and I know that this kind of option tends to add about 20% to project value. Okay, there really is something clicking around in my brain. There's some wheels turning. I've got some experience. I'm taking a shortcut. I'm not running the numbers like I should, but historically I've seen the outcomes of these projects, and I've seen it add this value. So I'm not just making numbers up, but they're not very precise either, right? So you can see a problem with this. Now, what if you're coming out of college and you've never done any of this? You've got no experience. Could you do the qualitative approach? You got nothing to lean against to get any kind of numbers. So it wouldn't do you much good. We're going to ignore the qualitative approach, okay? We're going to ignore that one. Then they do what's called a decision tree approach. And that just went out right there. That method is going to be our primary tool in these 2 chapters to deal with real options. We're going to build what's called decision trees. It's going to look like the different like our different scenarios. It's basically different scenarios is what a tree is. Each branch in the tree is a different scenario. Right? Each one's a distinct scenario. So we're definitely going to do that. That's going to be our primary tool. Another would be to use an option pricing model. So for example, the Black-Scholes option pricing model. We'll see. If we have time, we might look at it just kind of like as a curiosity towards one of the last things next Tuesday. If we don't have time, we'll ignore it, right? But we'll see. Then they give us something that's called a financial engineering approach. Now, to explain this one, we're decidedly not going to use that one. But in case you're curious, some of you have probably been putting your schedule together for next spring. And if you looked at the course offerings, one course that's going to be offered is called Speculative Markets with Dr. Gao. And that's looking at derivatives like options, financial options, not real options, but financial options, futures contracts, swap contracts, things like those. She's going to be looking at those and showing you like how they work, how to value them, how to compute returns off of them as they change in value. You'll learn all that kind of stuff. Well, inside of that derivatives course, that speculative markets course, there's something called put-call parity. And put-call parity basically says this. You could, for example, buy a call option. A real option usually is going to be a call option. You could buy a call option, or you could use other securities that give you the exact same payoff as a call option. They mimic it, right? So you have engineered the payoff of the call option using other things. And call option, C, which would be our real option, could be mimicked by having a stock minus a risk-free bond. This is something we're not going to do. This is a curiosity. If you guys are curious or really crazy or something, or have been drinking before noon, then this might be of interest to you, right? So we could put together a call option like our real option with a package of these things here. Underlying stock or risk-free bond that has a value equal to our exercise price, and a put option. Interestingly enough, again, if we have some time on Tuesday, this is equal to the NPV of our projects without the option. Interestingly enough. It's like our base NPV. So in a certain respect, kind of moving along the lines of this financial engineering approach anyway, which is not going to complete it. But that's what it's getting at. So what we're going to do is we're going to do the ignore part, as odd as that sounds, because that's our baseline. What's the option? What's the project worth ignoring the option? So we can assess how much the option adds value. To do that latter, we're going to do the decision tree approach right here. And if we have some time, we'll look briefly at the option pricing model. Not so much because we're going to use it here to value it on an assignment. We're not going to do that. We might be able to use the option pricing model to see how the various inputs, when they're changed, like what if a timing option, instead of 1 year to make your decision, what if you have 5 years? Does that make the option worth more or less? It sounds like it should be worth more. We can easily see that in an option pricing model a lot more quickly than we can in the decision tree approach. Why? Because decision trees, we have to work out all the math. In option pricing model, just put a few numbers in and let it compute things for us. It's a lot more efficient. Okay, that's kind of an overview of where we're going. Now, let me put up one more type of option up here. I'm going to put a line here. This one's going to be a little bit different. This one's going to be a staged option. I should put it up there first. A staged option is kind of like a timing option. They're very, very similar. The best way to show you this one is let's just go ahead and get our feet wet and let's look at an actual problem that does this. Let's put it together, see what the analysis looks like, see how to interpret the outcomes of the analysis, right? So let's go ahead to the back of chapter 13. Oh, by the way, in chapter 13, they talk about the decision tree process. They talk about various kinds of options, like growth, flexibility, all that, they do a better job of describing this stuff in chapter 13. All right, so that's, most of your information about real options will come out of chapter 13, not out of chapter 14. Okay, we want, not those. All right, that's the problem we want, is we want 13.7. So let me do this. There we go. So problem 13.7, Yoren Yacht Company. We're gonna work through this. So this is gonna take a little bit. It's gonna take some board space, and it's gonna take a bit of time. In fact, it's gonna be most of what, it's gonna be probably everything we do today. And then we'll move into problems in chapter 14 next week. Let's see what we've got here. Sailboat builder Yoren Yacht Company is May Design, right? So we can see here's the project that they're looking at. May Design a new 30-foot sailboat based on wing keels. Let's see, blah blah blah. So that simply says this is a project they're looking at, right? Capital budgeting project. All right. Second paragraph. First, Yoren Yacht would have to invest $10,000 at time zero today to design. For the design and model tank testing the boat. Let's see, it's gonna cost $10,000 for this testing phase. And they believe there are two possible outcomes at the end of the year, end of the testing phase. Either it's successful or it's not, and they walk away and they get nothing out of it. They spent $10,000, they walk away with nothing, okay? So that's stage one. In fact, let's go put this on the board. So they spend $10,000 today. This is stage one right here, right? It goes from today to the end of the year. So 1 year time frame. And we have two outcomes that are possible. Either we have success or we have failure. And it says, let's see, there's a 60% probability it's successful. So 60% chance of success, and that means there has to be a 40% chance of failure. So those are the only two possibilities. Let's see, if it's failure, it's stage one, it's not successful, the project will be abandoned with zero salvage value. No cash flow, we walk away. Okay? That's everything I know from that second paragraph, the first stage. The third paragraph, it says the next stage, if undertaken, okay? It doesn't say we will, but if undertaken, would consist of making the molds and producing 2 prototype boats. It cost $500,000 at time one, right here, but we're only gonna do that if we're on the upper branch where we were successful, okay? So we'll do the $500,000 here, not down here. Let's see. At time one, if the boats test well, Yoren Yacht goes into production. If they do not, the molds and prototypes are sold for $100,000. They estimate 80% chance they pass testing, 20% chance it doesn't. Okay? So this is going to be stage 2. Second year, right? So here we are, T1. If we are on this upper branch, we'd spend $500,000 here. And a year later, we are either successful, so we passed, let's see, we pass testing, we don't pass testing, okay? It said there's an 80% chance we pass testing. They didn't tell us 20, but if there's only 2 outcomes, there's 80% chance of the first outcome, there's 20% chance of the other outcome. Let's see, if we're on the don't pass, it didn't go well, we can sell what we produced for $100,000. It might not recoup our investment, it won't, but we can get $100,000 out of it, better than nothing, right? So we get something there. That's stage 2. Let's go to the last paragraph. Stage 3. Stage 3 consists of converting an unused production line in to produce the new mold. What's the potential issue you have to watch out for in this narrative now? Unused production line. Opportunity cost, right? Remember that? So what could it be used for and an alternative use? So let's see. This would cost $1 million at time 2, which is where we are right here, right? There we are, time 2. Would cost $1 million at time 2. If the economy's strong, the net value of sales, if you like, the NPV at that future date, not today, but at that future date, the NPV would be $3 million. If the economy's weak, the NPV at that future date would be $1.5 million. Both net values occur at T3. Each stated economy has a probability of 0.5. It's a coin toss, 50-50 chance of it being strong or weak, okay? Now they tell us the cost of capital is 12%. So let's put up here, stage 3. So we spend $1 million here. We either have a strong economy or a weak economy. There's a 50% chance of either occurring. And then the net value, the NPV on that future date, year 3, is either going to be $3 million or $1.5 million. And then lastly, we need to know that our discount rate that we're using for the project is 12%. Okay, it took a while. We have everything on the board. We can now start working. The first thing you guys should always do if you have a real option problem, draw it out. Do not do any of these things without mapping it out on your paper, because otherwise you try to work it and you're going to mess something up. All right, map it out, then go back through the narrative, see if you got everything, and if it looks like you have it lined up correctly. Okay, let's work this out. So how in the world do I do this thing? And here's my decision tree. You see all the branches everywhere, right? It's like a tree, it's a mess. So what do I do with this thing? Well, I've got in here, let's see, I've got 1, 2, 3, I've got 4 scenarios. How is that? Let me show you. Let's put them over here. Let's value them here. So let's see. I'm going to put cash flows here. So let's do a year, 0. We know it goes all the way out to year 3. Okay. And then my cash flows. So let's see, my first scenario, let's take the easiest one. What's the easiest scenario up here? Is I pay $10,000 and right off the bat a year later, failure. It didn't work, right? So the easiest one to think about right now is the bottom branch right here. That one. You spend $10,000, it was a failure after a year. So let's call this, let's see, let's call this, let's call this one right here B1, branch 1, okay? It's branch 1. So here's my cash flows. I spend $10,000, and then I get nothing. There's nothing right here. That's it. That's pretty simple. what do I want to get here? I want to know what the NPV of this is. I've only got one cash flow, it's 10,000 today. The NPV, 10,000 today. So that one's simple. All right, so there's that. Now let's go find another. So here's what we're doing. We're starting from today, and we're working through the tree until we get to an end point. We can't go any further, right? That is a scenario or a pathway through the tree. Let's find the next one that is the next shortest, okay? Let's find the next shortest branch. So if I did the next shortest, it's going to obviously be success, but then maybe doesn't pass testing, right? That looks like the next one. So here I've got cash flows at time 0, time 1, and time 2. And I can see what the cash flows are. Minus 10,000, minus $500,000, plus 100,000. Those are my cash flows. Let's put these up here. So this is going to be branch 2 for this one, this pathway here, all right? That's branch 2. So branch 2 minus 10 minus 500 plus 100, and then nothing after that. Let's get the net present value off of this. Okay, so I get minus $376,709. Okay, that's the NPV of just that pathway. So you can say that's scenario. Let's look for another one in here. So I wish I'd had the thought to bring other colored pens for this one. We're going to need them. So let's find the next branch. I'll do a dash line, okay? So success, pass testing, right? Because we've taken care of this branch here and this one here. So now let's do success, pass testing, week. Let's do that. So that's going to be the dashed pathway through. And that is going to be branch 3, right? So the solid black line was branch 1, the solid blue line is branch 2, and then the dashed line is branch 3. Our cash flows, minus 10 today, minus 500,000 in year 1, minus $1 million in year 2, plus 1.5 million in year 3. And like we did on these others, now let's go take our 12% discount rate and let's go and compute a net present value for it. All right, this one's negative 2. So this one is going to be minus 185,952. Right, so you can see where we're going to go now, right? We've got one remaining pathway through the tree that we haven't explored so far. Let's see. This one, let's just use a bunch of dots here. All right, so this one is going to be this upper branch all the way. Success, pass testing, strong economy. It's that one. All the way, top branch all the way through from start to finish. That one is going to be our branch number 4. We're going to use this sequence of dots as the pathway through. So this one almost like branch 3, except the final year, year 3, is 3 million instead of 1.5 million. So let's see what that does to the net present value. And finally, we get a positive. Here, we get 881, 718. So there's the NPV there. In case you're wondering, we're close to being done with the math. Right, we're almost there.
Are all the decision trees gonna look kind of like the more favorable option would be towards the top end, or are they?
You can
gonna
do it
look
either
down?
way. I would say make it a consistent way so you always know what you're looking at,
Oh, okay.
right?
Well, I was gonna say, like, is it gonna be more complex, like, the bottom, like, is it gonna spread out like an entire tree?
Kind of. It depends on the problem.
Okay.
So it's going to be like I said, capital budgeting problems, you have to pay a lot of attention because they can differ from one to the next. Do they have an externality? Do they have opportunity cost or sunk cost, all that? How do you deal with working capital? Is it a percent of next year's sales or is it some upfront fixed amount? They can change. It's the same thing here. They can change. We're going to do a lot of different problems, especially on Tuesday.
Okay.
We're going to do a timing option, a growth option, one that's got I think a timing and an abandonment option in it. We're going to do a number.
Okay.
And we'll see the trees unfold different ways, and we'll see how they're interpreted a bit differently.
Okay.
So hopefully you'll have enough exposure to enough problems, you'll see the differences in it. And that'll kind of give you, you'll learn through simply exposure to all these different methods. That's the hope. All right, so we've got everything here, right? We've got all of our pathways, all of our branches. We've had 4 distinct ones through the tree. Now what we do normally, if we have multiple NPVs, you do what? Multiple scenarios. You multiply each NPV by the probability, then add those products up and have an expected NPV. So we need our probability. We're going to multiply those together, and what we're going to get is we're going to take the sum of that. That will be our expected NPV, and that number is what we want to find right there. So we got 2 more sets of math to complete. I need to know what the probabilities are for each of those branches. I need to multiply each NPV by its respective probability, and then add those products up, and I'm done, finally, okay? So here's what usually tricks everybody up, is getting the probabilities. The first one's easy. What's the probability of branch 1 occurring?
40%.
Bingo, that was super simple, right? So that one couldn't have been easier. So that was 40%. Now let's do this over here just to make certain. Our probabilities. So branch 1, it is failure, which is 40% or 0.4. So minus 10,000 times 0.4 is minus 4,000. There's our first data point. We're gonna have minus 4,000. Make certain to have the negative, okay? Let's see, branch 2. Now this one gets interesting, right?
Would this one be 12%?
How'd you get that?
I did the 60% times the 20%.
Awesome. That's exactly what you do. When you've got a sequence of these things, and if we say they're independent from each other, we multiply the 2 sequential probabilities.
So like that whole upper path is 60% likelihood, then you just split it off
Mhm.
one by one.
Yeah, so
Okay.
success times don't pass probability. So success is 0.6, and don't pass is 0.2, so you got 0.12, 12%. It's exactly right. So take that NPV that we got, the minus 376,709. Again, make sure to put the negative in there. Multiply it by 0.12. We're going to get minus 45,205. And add that in with that minus 4,000 if you're kind of keeping a running total. All right, so we've got those. And now you see what's going to happen, right? The third branch, we get success times pass times weak economy. So I just put SPW, right? Success, pass, weak economy, just the probability of each branch. So I know the upper branch is 60%, pass, the odds are 80%, and then weak economy is 50%. So that's gonna be, looks like 24% there, 0.24, right? 0.6 times 0.8 times 0.5, should be 0.24. Multiply that 0.24 times that third scenario or third pathway's NPV. Okay, make certain put the negative in there for that one. And you should get, for just that one alone, minus 44,628. And add that in with the other two that you've got. So keep a running total of these things, right, of your sum. And then branch 4, right? So branch 4 will be success, pass testing, strong economy. Upper branch all the way, so 0.6, 0.8, 0.5 again, so that's going to be 0.24. By the way, real quick, these are all the possibilities we have. They have to add up to 1 or 100%, right? They have to. So that's a quick check. If you add these things up and you get like 105 or 87, you know you've messed something up, so go back and check it. All right, so 24% times that final NPV is 211,612, and I want to add that in with the others. So my grand sum of this thing, my overall expected NPV is 211,612. What do you guys think the decision is for this project?
No.
How come? How come?
My thinking was, well, I mean, it's only 24% chance that everything goes right. You have positive NPV.
Anybody think we should do it? Who says we shouldn't do the project? Who says we should do the project? You guys are all wrong. Here's how we interpret this. For a sequential or a staged project, a stage is called a sequential project. And before I even show you how we're going to interpret it, I'm going to give you kind of another, it's like a game show where like you got that wrong, maybe. But I'll give you a chance at this, just to see. So here, the next stage, if undertaken. So I'm getting at, we could do this. We don't have to do that. We don't have to do that. When would I do stage 2? In what state of the world would I be doing stage 2? Only if we're successful here, right? If I'm down here, I'd walk away. In what case would I do stage 3? Only if we passed up here. Now, so how do I look at this? First off, while there's a high probability we get negatives up there and a low chance of positive, the positive is so good, we get a positive expected NPV. It doesn't mean we accept the project. The interpretation is a bit different. It means we should invest in stage 1. Right, so the expected NPV is positive, so invest in stage 1. Doesn't mean we're going to buy the whole project, right? Go all the way through. It means we're going to do stage 1. And then what's going to happen? What's going to happen at the end of stage 1?
We're either going to pass or fail.
We're going to pass or fail, but do we know which case it's going to be today? We don't know, right? It's uncertainty. do we know that in a year from today, it's gonna cost us $500,000 to do stage 2? No, it's an estimate, but a year from now, inflation may be so high it costs us $800,000 to do stage 2. Do we really know there's an 80-20% chance of success or failure? No, it's our best guess, right? So these are our, with the exception of the costs right here, these are our estimates, probabilities and future cash flows and outlays. But since the expected NPV is positive, we should invest in stage 1. And then do what after a year? Reevaluate the project to see if we do it, if we go to the next stage. What does reevaluate the project mean in a year? So we're gonna do stage 1 because the expected NPV is positive. And then a year has passed and now this becomes time 0. This becomes year 1 and this becomes year 2 because we're a year further advanced, right? We've only got 2 stages remaining on the project. So what would we do in a year's time? Well, if it's unsuccessful, we just walk away. But if it is successful, then we want to go and get brand new data because the values may have changed, and they very likely would have. In other words, my capital budgeting team is going to go repopulate the remaining tree, which will just be this stuff right here, with new cash flow data and new probabilities. And maybe the cost of capital's changed too, right? If rates keep going up in the economy, it certainly would raise the cost of capital. That could change that could give us, we get another expected NPV. What if right here, we redo the expected NPV with what's left, and we get a positive again? What would we do? Invest in stage 2. Do we know that today? No, we would know that in a year, right? What if we get a negative expected NPV? We walk away. We don't do it. You say, but you've done stage 1, you spent that money, yeah, but we've limited our losses, right? So this says do stage 1, but you don't commit to stage 2 or 3. If you get through stage 1, you reevaluate, and maybe it's worth going and investing in stage 2 if the expected NPV at that point is positive, or maybe you walk away if the expected NPV is negative. Now, I know what you're thinking about, Sir Jess, I saw a big chance of it being negative, but there's 2 things here. The expected NPV is weighing both this high probability of it losing money versus the really good outcome and the low probability if it does make money. But we're also only going into it a step at a time. So we are mitigating our risk by doing this. We're not committing to the entire project, we're committing to a stage. We do this and we get a positive expected NPV in a year, so we do stage 2 with all new data. We got another expected, or another positive expected NPV, so we did stage 2. Then we go through a year, and at the end of that year, if we're down here, we're probably just gonna walk away again. But if we're up here, does that mean we're gonna do stage 3? No, we have to get brand new data for the last stage, redo it again with the remaining strong or weak scenario possibility, but with brand new data because things will have changed after a couple of years. Then we get to here, and the expected NPV is minus. So after all of this, we walk away at the end. That could happen. But again, you're going in stages, so you're limiting your risk exposure as you do it. What companies do this stuff? Pharmaceuticals are the best example. When you think about it, what do? They'll start out with research and development, right? That sounds like stage 1. A lot of drugs never make it out of R&D, ever. They spend a lot of money, but they never see the light of day. A handful will go into various kinds of testing and clinical trials, right? There are various stages to that. So they might do testing in the lab, for example. That might be stage 2. So they, Pfizer might commit to an entire drug program today, or they might commit to the initial R&D stage of a drug program today, but they've mapped everything out to the end, what they think is going to happen in order to get the value. But then after the initial R&D, or maybe even part of the way through, they reevaluate, after they're done with that first stage, they reevaluate the remaining stages to get another expected NPV. And if Pfizer says, okay, the NPV is still positive, maybe it's a little bit less so, or maybe it's gotten more positive, let's go ahead and do the next stage. Let's do in-house drug testing on this thing, right? And they get through that, and maybe it didn't come out good, so they walk away from it. Or maybe it did, so they could go ahead with it, but they don't necessarily do so. They go and reevaluate the remaining stages with new data, reflecting new market conditions. Maybe now they're going to do national clinical trials in that third stage, right? And then after that, it becomes FDA approval, and let's market it for mass consumption, right? So each of those different stages, they have a decision point. So there's a decision point right here, which isn't to accept or reject a project, is to accept or reject stage one. And then if we do stage one, we have another decision point there, which is, do we advance to the next stage? We have to evaluate everything else to the end of the project to know that. And then we have another decision point right here. Right, so every one of those, we have a decision point on this tree. Energy companies do the same thing. Like if you have an energy company that does, they drill onshore, for example, before they ever put an oil well down, what do? They go and have their geologists go out and survey for possible oil, right? The survey results may say a high probability of oil, and then they go back and they take that information back and they get their economist or their finance people in-house to say, here's the price of oil, let's map out the decision tree. Like from today, the survey to the next stage, which might be put one or two wells, a test well down to see what comes up, right? Maybe several test wells. We're not going to put like 100 wells in a field. We might put 2 or 3 to get a sampling of the field to see if it looks promising. And then the next stage might be fully develop the field, right? So you can see multiple stages for the oil and gas company. So they do this, they evaluate the entire thing start to finish, but stage one, they're only committing to stage one. If they do the survey with the geologist and it comes out, everything looks good, they get a positive NPV. They do that stage, then they go reevaluate test wells and then the full development. They reevaluate that whole thing. So this happens an awful lot with companies where they have staged investment. And this is how you evaluate it, right? This is the way it's done right here. That pretty much took most of our time up today, kind of the overview and just going through. This one's a long one. And it's an interesting one because it's not your usual, like we don't accept or reject it. We either decide to do stage one or we walk away, right? And that's what it is. And if you do stage one, at the end of stage one, you reevaluate the project and go through the analysis again for stage two. That's how these work. When we get back in here on Tuesday, we'll do a growth option. We'll do a timing option. We'll do an abandonment option. We'll have at least one project that has several options combined in it. So it's going to be kind of interesting. And then we may or may not have time to do the option pricing model. If we don't, we'll see. Right? So that's what we'll do on Tuesday to finish the chapter. Okay? The capital budgeting cash flow policy. Yeah.
And did we send you see an example of that stuff that we did last time?
The simulation?
Yeah.
I got in here and I realized I've got my computer in there and I was like,